Hello and welcome to the RAS Network. What you're about to hear and see is limited to general financial information only. Please be sure to speak to your financial planner or refer to our financial services guide available at rask.com.au/FSG before acting on the information.
G'day, welcome to the Australian Property Podcast. I'm Pete Wargent from Alan Wargent Property Buyers, and I'm here with Chris Bates from the Flint Group. G'day, Chris. How's it going?
Things are good, Pete. It's it's a bit of an interesting time. Obviously, we've spoken a number of times on this podcast that the springtime's always interesting for us to sort of see what happens. And we spoke about it the last couple of weeks. We've absolutely seen a bit more activity and a bit more urgency from our buyers, which it does happen at this time of year because there's usually better listings coming on. But buyers who have been a little bit not wanting to commit, I guess. And we've actually seen them no, I want to get moving. I don't want to let this market run on me. So it's a bit of an interesting story, completely different to what obviously the media is saying as well. So what about yourself, Pete? What's been keeping you busy?
Oh, just booked my flights for Boston and LA. So I'm doing a bit of a travel around the world over the next 2 or 3 weeks and then back to Australia. So mainly just keeping my schedule busy, and obviously it was Father's Day just gone, and Brisbane Lions playing this weekend, although this goes to air on Sunday morning, so the result will all be known by then, hopefully a win over Carlton, so we'll see. Just ticking along.
Oh, Father's Day was a good one here. Played football in the morning, and then we hired probably the cheapest boat you could probably get on Pittwater, some little picnic with a 8 horsepower motor on the back. And went out with some friends and cruised around Pittwater and up at Ku-ring-gai Chase. It was a good day actually, and kids were driving the boat, which was probably the safest boat they could possibly drive. So, what about yourself? Did you do much for Father's Day?
No, not really. I'm interested to know people out and about spending in Sydney and New South Wales. How are you seeing things in terms of consumers? Because obviously a lot of the data is showing a softening.
I think that people have to be making cutbacks, right? I look at our clients and the mortgages and how much they've gone up over the last few years. And absolutely, they'd be making substitutions or deciding not to go to this restaurant and go to a cheaper version. And but it's so ingrained, right? Socializing and going out and going to cafes and restaurants and things like that. But I'm sure they're making cutbacks around the home. I was just chatting to our gardener actually this morning, and he was saying, business is absolutely a lot lighter for them. A lot of people doing less home repairs and even the architects locally up here on the just yesterday emailed me and said, look, they're seeing absolutely builders come to them, and he thinks that they're actually building prices are going to stabilise or fall, which I haven't really heard from too many architects. So I think people absolutely are living a more subdued life, right? While you're going to Boston, we booked 3 nights up at Southwest Rocks. I think people are absolutely making cutbacks with travel and discretionary spending. But it's also the fixed costs that are killing people, right? Whether it's their rent or their insurance, things that you can't really change are also running on them.
Well, that was one of the key releases this week. So the Australian National Accounts came out. They always lag a little bit. So this is really referring back to the June 2024 quarter. And it's, we're already into September, so it's very much rear view mirror stuff. But the economy grew 0.2%, so basically flat. And actually, it was only positive because of public or government spending. So over the 2024 financial year, GDP was up 1%, but actually population growth was 2.5%. So if you think about GDP per capita, it's not something people used to talk about years ago, but over the past 5 years, we tend to sort of talk about GDP per person or per household. Well, that's backwards 1.5%. So in that sense, we're in a sort of per capita recession, and productivity is just really struggling. And I don't know if that's because people are working from home more, or there's just other issues in terms of supply chains or the economy. But it's quite clear households are really struggling. The savings rate for households has been all the way through 2024, about 0.6%, basically nothing. And if you take into account things like superannuation contributions and so on, well, it's really depleting for a lot of households. So there's not much spending power in the economy at the moment. And I suppose, as you said, interest payments on houses and mortgages, well, they've continued to rise, even though the cash rate's been stable. The fixed rates resetting to higher mortgage rates is just sucking so much money out of the economy. And I suppose there's been no growth at all, really, for a year now.
Yeah, I mean, absolutely, households are struggling. I mean, but they're all looking for that. They do hanging on by their fingernails and doing everything they can to not sell. I mean, they know that entering the market, and they've been surprised, right? You'd have to be, let's say you did sell, and things got a bit too much the last couple of years, which absolutely has happened. And then you'd think that prices would have kept falling, and then they actually went up, right? It'd be a really hard pill to swallow right now. You've got to get back into the market. You can't get back in because your borrowing capacity is not there. You got to pay stamp duty. You've paid selling costs. Maybe you didn't buy again because you didn't have the means, whether you lost your job or something like that. So I think this is the real issue. If people can't hold on for another 6 or 12 months with rates being a little bit higher, and then rate cuts happen and borrowing capacities go back up, then, just that ability just to get through the next 6 to 12 months is going to be tough for a lot of households. They've really exhausted all their buffers, all their liquidity, sold their shares, sold down the car, reduce their cash flow as much as they can to stay in their homes. And I think they're asking family and friends even for help. So, I think it's, but, there is good news on the horizon, right? Like I think in the last couple of months, the rate trajectory is completely flipped. Just before this, we both checked it, right? About 3.3 is roughly what rates are likely to be by the end of next year. But that's been going like a seesaw back and forth. So don't, place your bets on that would be my call. Who knows what data we're going to get over the next few months. But it has been, even that GDP data is showing that the effects of higher rates are absolutely doing their job.
I think so. We'll crack on with the 3 news stories of the week in a second. But other news this week, job ads fell for a 7th month in a row to be down 23% over the past year, now the lowest level in 3 years, according to ANZ Indeed. Also, the Melbourne Institute puts out its inflation gauge, which runs, I guess, ahead of the ABS figures. And the core inflation figure was down to 2.2%. Now, can't show this on a podcast, but normally you find that the Melbourne Institute gauge, more or less the ABS official inflation figures kind of follow in the same trajectory. If we get anything like that over the next couple of releases for the ABS, well, the Reserve Bank will be doing an about face on its hawkish rhetoric, and we'll be getting interest rate cuts. In fact, this week, Canada cut interest rates for the 3rd time. And as you said, if you look at market pricing around the world, not just for Australia, but for the US, 3% pricing for the end of 2025. It's even lower in some parts. If you look at the Eurozone, United Kingdom, Bank of Canada. So interest rates are going to come down more or less all over the place over the next 15 months or so. And it's most sort of more likely than not that Australia will follow in a similar trajectory. Maybe not until next year, though. So I think people are just hanging on, I guess, and looking for a bit of respite sometime in 2025.
Yeah, absolutely. All right, this is an interesting first story, Pete. Let's crack on with that because, I think it's a storm in the teacup.
Well, so each week on the 2 Cents segment, we look at the big 3 news stories of the week. One that really caught the eye, the spring selling season off with a bang. So SQM Research was first cab off the rank in terms of getting the figures out there. And finally, it seems a bit of a surge in listings. We've been saying for much of the past few years how low listings have been, but there was a relatively strong rise in new listings in Sydney and especially in Melbourne. In fact, our mutual friend Kate Bakos wrote a blog this week and said there's a few micro gluts in Melbourne of little pockets and suburbs where there's suddenly a whole surge of listings. And that's just taken some of the pressure off the Melbourne market. There's some price discounting around, some bargains being found in some parts of the market. Now, if you look at, say, Perth and Brisbane, not really. There hasn't been any sort of increase in listings and they're much lower than a year ago, but not so in Melbourne, it seems.
Yeah, it's interesting. I actually coincidentally spoke to Kate as well. We sent her a client and she was sort of indicating, even though it was a private email, but she was indicating that, there is a bit of, because higher listings isn't always such a problem if the market's absorbing them, right? And so if you are going through this period of more listings and they're still selling, right? Yeah, prices aren't rising, but there's enough demand, right? As soon as listings do get a bit tighter, right, then you can see there's still a lot of demand there. And I think that Melbourne's actually got all the essence of being a really strong growth over the next, 5-10 years. I think there's so much the affordability gap between what Sydney prices and Melbourne's prices have been is really blown out over the last few years because Melbourne hasn't gone up. And so absolutely, there's always going to be gluts of high density, or maybe it's houses in the fringes, or maybe rundown houses in the middle suburbs, or maybe it's, new townhouses, or, there's lots of villa units in the market because a lot of investors are bailing. So definitely you're going to find these gluts around the city. But then if you look at some of the scarcer properties in, better streets, I very much doubt there's any glut of those. And I think the Melbourne market is holding up, even under high listings. It's not falling, right? But absolutely, it's going through a lot more challenges to maintain prices because there's a lot more on the market.
Yeah, so if you look at SQM's figures, in August, the number of listings nationwide was up about 8% to 249,000, up from 231,000 in July. I think, Melbourne listings were up 23% from a year earlier. And yeah, Kate made a good point in her blog. If you look at the types of properties being sold, well, there's a lot of landlords selling up, investors selling their investment properties because I suppose there's been land tax increases on top of the mortgage rate increases. There's been, I guess, a number of other issues, changes to tenant rights. I think just the Victorian economy in general has been under pressure. CapEx was down 4% or so last quarter. The unemployment rate is higher in Victoria than elsewhere. So there's a few people leaving, I guess, from an employment perspective. So it's not like there's one factor. It's just a confluence of things coming together. And it's caused some landlords to sell up. So the REA Group Chief Executive Owen Wilson said 39% of Melbourne properties sold in July belong to landlords, the highest figure of all the Australian capitals. So I guess if you're looking at the types of properties being sold and the types of vendors, well, it's generally a lot of landlords and probably in some of those pockets where you get a lot of investment properties.
Yeah, absolutely. I mean, the whole listings rising. I mean, I remember back, it's almost every year there's the spring listings are coming earlier and earlier. And, it makes a lot of sense, right? When there is a bit of a dry up of listings over winter, you do want to list your property when there's not a lot of properties like your property on the market. So maybe a lot of agents are saying, well, why don't you get your listing in early and then we can basically get it on the market when there's not much competition. The problem is if every agent's, tooting that same drum, then you're going to see a lot of listings come forward, right? And that's what I think absolutely has happened. Remember back in 21 or 22, everyone was like, oh my God, the market's going to crash. There's all these listings coming on at the end of winter. And it was all over the news. And I was like, I just think as agents front running listings. And what you saw is later in spring, the listings really died off. And I think a lot of people are comparing listings to what there was last year or what there is to the 5-year average, but go and compare it to a 10-year average. Go compare houses versus apartments. Go compare better houses versus poorer streets. There's just not this listings problem and this heaps of choice for buyers. It's just, it makes great news. And I think what's happening is the media is latching onto that and going, oh, it's, buyer's market and, buyers have got heaps of choice and no competition. That's just not true. And I think what we're going to see, SMH had an article last week saying, Sydney markets, really cooling off. And because the growth rate has been slowing down in the first half of this year, because there is this pressure on higher interest rates and prices of hitting this affordability sort of cap. But that's because buyers were also saying, look, I'm not unsure about where interest rates are going to go and I'm already stretching. Do I want to really stretch if rates are going to stay high? And I can see the market slowing down. So maybe I don't need to buy. But I think what we've seen in the last month or so, that rate trajectory changed. And we've seen our buyers respond very quickly to that and say, actually, I'm way more confident on where rates are going to go. I'm going to look to transact. I'm keen to buy. And what you'll see is that'll then lead into prices, and particularly at the top end. I think the medians get pushed when the more transactions happen at the top end, right? And they get dragged down. And so I think what we're going to start to see is more and more transactions at the top end. And I think we're going to be surprised when we come back to December and go, oh, actually, no, the Sydney market's bounced. And even though the news articles are saying it's slowing down and price growth is going to be very limited.
Well, it's an interesting point you make. I've just brought up the figures here, total property listings on SQM's figures. If you were to look at this graph, you would actually say there's a massive shortage of houses for sale or properties for sale. 250,000. If you went back a decade ago, the figure was about 350,000. And bear in mind, the population of Australia is about 4 million higher over that time. If you were to just take these figures at face value, you'd say, well, we've got a real undersupply of properties on the market. So yes, we have actually increased from a year ago, but yeah, nationally, 249,000 is not that much. Just to go back to what Kate Bakos was saying in her blog, investors typically spend less on an investment property than they would for a home. So there's a few sort of gluts of properties for sale in the lower price points, which tend to appeal to potentially first home buyers or downsizers, but also a bit of a surge of listings of older houses on full parcels of land, probably due to tighter rental reforms or compliance requirements in Victoria. So yeah, there's it's not the same across all parts of the market, as you said, Chris. Sometimes when you're looking at your portfolio, if you've got properties that tick all of the boxes and they're A-grade assets, well, you just want to hold on to those for as long as possible. Sometimes if you're offloading, it's kind of those B-grade or sort of less good assets in your portfolio. Maybe those are the ones you offload when the market's strong. So yeah, it's a bit of a mixed picture of even within the market, I suppose.
Yeah, I think there's I've done a number of property calls in the last few weeks, and it's interesting. A lot of people are starting to say, hang on a sec, what happens if I go down this rent vesting strategy? Or rather than upgrading my home, I buy an investment property, but I do need to upgrade in the future. And they're starting to think, hang on a sec, if I get caught out here, if I go into these investment markets and I'm already a bit late to the party anyway, and I don't get as much growth, and maybe they don't perform as strong as I think they're going to perform, and then I don't enter into the housing market where I obviously want to be in 5-10 years time or even earlier, then and that market runs on me and my current property doesn't grow as much, how am I going to deal with that? And I think a lot of people are flipping back to actually know what makes sense is sorting out our owner occupier, because under higher interest rate, rent vesting makes a lot of sense, right? Less leverage up on your home, more leverage up into investments. But if you go back to lower rates, it makes sense to invest in tax-free assets and the owner occupier market, because that market will do better in a rate fall market, I say. And so, yeah, I think it's an interesting dynamic playing out, and home buyers, particularly under a rental market stress where they, it's getting harder and harder to rent. And I think that's why I'm not too concerned about the Melbourne market and investors bailing. It's not great for renters down there. Melbourne's actually been a really easy place to rent over the past few periods. Yields are very low. It's, you've got a lot of choice because there's been a lot of investment down there, whether it's apartment, even houses. But as the rental market gets tighter up there because more and more investors bail, then that sort of creates that desire to own. And that'll actually be one of the ingredients that actually creates a stronger home buying market and will actually be one of the reasons why I think the Melbourne market will boom. So it sounds counterintuitive. You don't want to go where a lot of the investors are leaving, but actually you do. You actually want to be where they're not buying, and you want to move into markets where owner-occupiers are going to drive markets.
Well, you're right. I mean, if you look back over the past decade, the mainland capital cities with the cheapest median price have been the best performers over the following 5 years. It was the case in Hobart, it was the case in Adelaide, and then Perth. And yeah, actually, Adelaide now has a higher median house price than Melbourne. So does Brisbane. I think that's the first time in 40 years, CoreLogic said, of all the time they've been measuring the figures, the median house price of Adelaide has never been higher than Melbourne. And now it is. Obviously, you're not really comparing like with like, because the median house in Adelaide is much closer to the heart of the city and the beach than it would be in, say, Melbourne, which is a much bigger metropolitan area. But still, it's pretty interesting stat that the median price could be higher. Let's crack on with this second news story. Bottom of the cycle for building approvals. So finally, house approvals really surging back across Perth. They're rising in Melbourne. They're rising a little bit, at least in Adelaide and Brisbane. So I think if you look at it, unit approvals are still very slow for now. But it looks like we might have turned the corner. Nationally, the best result in a year last month. I think, I mean, there were 2,000 attached dwelling approvals in Melbourne, but Sydney and especially Brisbane, extremely low and very lackluster. So, yeah, I mean, we've probably bounced off the sort of 10 or 12-year lows, but over the year, still only 165,000 building approvals. And when you bear in mind that probably 1 in every 10 of those replaces an existing dwelling, we're still probably about 50% below where we need to be, but maybe probably the bottom of the cycle now. It looks like there was a lot of activity in infrastructure and mining projects, but that's easing off now. Maybe some of the activity swings back into to actual home building, which is what we really need.
Yeah, I do think there's a real strong, with all these council zoning changes, and if you can get yourself a decent block of land in an area that isn't going high density, but along busier roads in sort of middle inner ring suburbs. The problem is when those developments happen is A, they're very expensive and they're not cheap builds, so they only suit a certain target market, and B, they can't usually build too many of them. So you're not getting hundreds and hundreds of apartments. So you're getting an 8 block, a 12 block, a 20 block, and I think that's where I think the feasibilities stack up, and I think absolutely people will be land banking those blocks just because the payoff can be so much bigger. Is that sort of what you're seeing as well, Pete? Is it's really, you're going to create more housing in the more affluent areas, and rather than the cheaper areas where the numbers just do not add up for developers.
Well, if you look at unit approvals, the trend for Brisbane is just diabolical. Queensland, there has been a bit of activity, but I think it's really the sorts of projects that are getting up are like Gold Coast, apartments with ocean views, where you can charge a bit of a premium on those types of development, but just the average suburban duplex or townhouse development or block of units, the developers just there's not enough margin there, and the trend is diabolical in Sydney and Brisbane. Melbourne's pretty lackluster, and this is just a massive change from the previous cycle. If you went back to 2016, 2015, around then, there was a massive surge of building approvals, largely to a lot of offshore investors in China. I think that was where a lot of the investment came from. But this time around, not really happening. So yes, we're getting more suburban homes built and houses, but unit approvals very, very lackluster. I mean, things will pick up from here. I think lower interest rates will help. If APRA ever releases the lending assessment buffer, that will help. A bit more confidence, I suppose. Over the past year, we've had 3,000 building, construction, and development firms go bust. So it is a bit of Russian roulette there, I guess, if you're choosing a developer, because we've got a massive surge of insolvencies. But I think eventually we should come out the other side of that as well. So yeah, look, it's a long haul, because generally those medium density projects take 2 to 3 years to come to the market. And in fact, I was reading Charter Kramer's apartment state of the market report, and yeah, there's just a big shortage of new units and apartments really for the next few years, especially in the bigger capital cities, it looks like.
Yeah, approval is really the right number to track, to be honest. I think that, it's great that it's getting approved. And if you had a apartment complex approved before, you might actually go back and try to get it reapproved with some, some more levels, or, a greater floor space ratio, et cetera, to the block, if council rules are changing, I think. But what actually gets commenced is kind of the number you really want to see. And I think that's what my worry is, that, yeah, we're seeing approvals go up. Do people actually go and build these things, or are they just getting ready to build them when the time's right? And what's your take on that, Pete? Is that something that we probably should be more focused on rather than the approvals? But, I mean, obviously they're interlinked, but what actually starts matters.
Yeah, well, I can give you the stats. So in the March quarter, there were about 26,000 detached homes commenced. So that was an increase on the previous quarter of about 6%, but multi-units, only 14,000, and that was down 6% from the previous quarter. So yeah, for sure we'll get a bounce, but 14,000, it's just a very, very low number. When you think about the pace of net overseas migration into Australia, yeah, and those are projects that take time to come to market. A detached home you could build in 6 to 9 months, but a multi-unit project takes time, takes years, So yeah, look, it's we're expecting to see an acceleration, I guess, in commencements over the next year or two. But yeah, it's going to take quite a long time before that sort of really meets the demand for new housing. So yeah, it's going to be a long slog. But I suppose at least that should provide some activity in the economy, because generally speaking, it's been pretty lackluster of late.
Absolutely. Should we crack on with story number 3, Pete? Because I have actually seen a bit of explosion. We've got a new office and we're setting up a whole video studio, and just been doing a bit of market research on YouTube, and it seems like every second title is our third story.
Well, it wouldn't be an Aussie property podcast without one of these stories. So Forbes did a piece, is the Aussie property market going to crash? So it seems like pretty much every year that around this time, we either get a 60 Minutes or a Four Corners, or there's always this sort of perennial sort of doom and gloom podcasts and stuff out there. I mean, I suppose one of the things is, what actually is a crash? I mean, is that a 15% nominal fall in prices? Is it 25%? You could choose your own definition, I suppose. So the Forbes article basically said it's been a bumpy 4 years for residential property. There was a boom during COVID, followed by a minor bust. Then prices started rising again in 2023, only to taper off that year. 2024 prices are up again. I suppose that sort of tells the story, doesn't it? Property is an asset class that you tend to hold through longer periods, and you could get a rubber neck, I suppose, if you spend all your time looking at those kind of articles. The piece quoted a couple of couple of experts, including Tim Lawless from CoreLogic, and look, I suppose these articles are designed to get clicks. But in terms of their conclusion, no is the answer. They don't think the federal government's going to get anywhere near the national target of 1.2 million homes over 5 years. And even though prices are stretched and there's affordability issues, especially for houses in some of the capital cities, the demand for property is still sort of outstripping the supply at this stage.
Yeah, I think we've all been taught a little bit of a lesson of yes, interest rates and borrowing capacities have an impact on the market and absolutely slow down demand. But I don't think people realize how much it would slow down how humans would behave. There's a psychology behind the market. And what do people do? Okay, my mortgage is more expensive. Do I sell? Well, no, I don't, right? I actually just, because if I have to sell, we'll have to get back in. There's an owner-occupier element to all this, security and stability for my family. I've got this inherent belief that prices will go up over the longer term, so I'm more likely to ride through the tough times than, asset classes like shares, a little bit more volatile because people just sell in and out. The collapse in listings, particularly of good assets. You've seen listings increase in some areas where investors are going to absolutely bail because, there's no attachment to living in it, so they can just get out. But the rental crisis leads into that, and that also forces people not to sell. And so I think, that real sort of belief that if something happens, then there's going to lead to this in prices. We've all been taught a lesson there that it's just not that simple. My genuine concern right now, though, is for people who are looking to enter the market, is that if you start to get this headwind of higher rates and lower borrowing capacity turns into a bit of a tailwind, and buyers are more and more confident on where rates are going, and more borrowing capacity is coming, I do think there's going to be this, intergenerational wealth transfer is going to pick up pace, because it makes sense, right? If you're in a fortunate position and you've got a lot of cash, and you can start to see that your kids and your grandkids, right, the market's going to run on them, and you're tracking that market, and you're someone who has looked at that market because you've got a bunch of wealth over different properties. It makes sense to start to give it away now than give it away in 5-10 years, because you've got that overconfidence sort of belief that, that if they don't do something now. And I think while parents have been helping a lot in the last couple of years, I think it's, if they've started to get that happening more and more, wouldn't you want to help them before the market runs? And I think that we're going to see, because if a kid's asked to help us, you say, I can help you, but, should you really be buying under higher interest rates and low borrowing capacity? Is it really the good idea with your work? But if work options start to look better and rates start to look better, you go, actually, no, let's help the kids. And I think we're going to be blown away with how much equity is actually in the property market, particularly when that older generation looks to transact as well, because they're actually debt releasing or cash releasing events, so they downsize from their house into an apartment or move up the coast. They become, asset rich, cash poor. Then they become, asset rich in a certain way, but they actually become cash rich as well. And that's usually a time when they can actually give money away. And they usually want to do that when markets are really positive. So as market gets more positive, you'll see more of that downsizing, sort of right sizing, and that'll also be money flowing down that'll be re-leveraged by the younger generations.
Well, the Forbes article concludes that ANZ economists expect capital city housing prices to rise 6 to 7% this year before easing next year. But as the article goes on to point out, it's a multi-speed market. Perth and Brisbane are really firing, and Adelaide's been strong. But then Melbourne prices have been easing, same in Darwin, same in Canberra, same in Hobart. So it's a pretty multi-speed situation out there. Chris, you guys as mortgage brokers always get a first read on this stuff. Are you getting a bit of inquiry around the top end of the market? Is there a bit more confidence coming back up there?
Oh, absolutely, Pete. We are always heavily weighted a little bit to the sort of $1 million plus range. I mean, that's just been where, as a business now, we absolutely help a larger range of clients because it's a much bigger business than, say, a few years ago. But we've got a lot of experience, particularly in the sort of the Sydney, Melbourne, Brisbane housing markets, and everything from the 1 to 2s, 3, 4, 5s plus, right? And the 1, 2s have still been sort of transacting. Absolutely, there's still a lot of them are first home buyers. Even if it, to you, that wasn't where you're buying first. They've left it later. They've gone and travelled. They've worked on their careers, and they're entering the market later, and their incomes are quite high, and they're getting some help from family. And so a lot of first-time buyers enter in that range. But the 2+ range is kind of frozen up. And you can see that price growth hasn't been there. It's been sort of medians have sort of been falling. And I think that's not really falling. It's probably just that, with medians, they're looking at what's selling in a suburb. And there's a compositional bias here where it's the poorer properties in suburbs are transacting, and the better properties everyone's just sitting on. Like, why would you, you can't see any other better properties on the market. You just stay in your good property. You don't want to leverage up. And so I think that's really weighing down on the median price growth at that end, because it's just the compositional bias. But in the last few weeks, we've had lots of clients who have been sniffing around in this upgrader space, but there's been a real urgency to sort of transact. And, we've probably had 4 or 5 clients, 3 mil plus purchases just in the last week. Everything from the inner west to the beaches, in the east as well, and up the coast as well. So, yeah, there's lots of people, I think, in that range that are like, you know what, I actually do want to do this, and work's going well for me. We have got a bit of equity. We've also been using the 95% option at ANZ, which is a crazy deal for properties over 2 mil. And some of those upgraders wouldn't have been able to upgrade unless they were able to get access to that policy. It's a new policy in recent months. So, yeah, a lot more interest in the $2 million plus range than there has been for a good probably 12, 18 months. So hence why I'm a little bit, more confidence that, that you are going to be surprised with price growth over the next few months. And people are going to be like, oh, wow, prices aren't cooling off. There's been a bit of a second wind. That happened back in 2016, if you remember, Pete, where the market was really slowing down in that 2012, 2015 boom. And everyone thought it was the end of the boom. And then bang, it went on for another 2 years. And everyone sort of missed that last couple of years. They got out and they put money in the bank, or they didn't think it would continue, and it did.
That's why I'm always keen to speak to you guys, because you get first read on what's happening, I guess, as brokers. And we see it later on, I suppose, as buyers agents. But certainly in Brisbane, there's a lot of competition still for good properties. And yeah, it's same in New South Wales. We're mostly in the coastal markets and Newcastle, but there's still plenty of buyers around there. I can see from the reporting that it's different in some other parts of the country, but certainly in those markets still pretty buoyant. So look, those are the big 3 stories of the week. Spring selling season's kicked off with a bit of a bang, so a bit more choice. Might spread the buyers out around the joints, I suppose, over the next 3 months before things start winding up for the silly season. So it'll be an interesting couple of months ahead. Also, bottom of the cycle for building approvals and the sort of biannual will the Aussie property market crash article, which Forbes concluded with Nicola Powell from Domain and Tim Lawless from CoreLogic. Well, probably not, most likely, but maybe a bit more supply over the next year or two. So come and join us on the Rask Community Forum. There's a whole sort of chat forum, great free resource there if you've got questions or just want to have a chat. And if you've got any questions for Chris or I, you can always shoot us an email. Chris, what's on for the weekend? It's AFL for me.
Pretty quiet one. I think my wife's going to a bit of a hens party or a ladies' lunch sort of thing on Saturday. It's too crazy. And just some family time on Sunday. But a weekend in Sydney this weekend and nothing too exciting to report on.
Well, keep out of trouble and have a great weekend, everyone. And thanks for joining.
Happy Sundays.
Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.